The subcommittee will come to order. And live from Washington, D.C., the Financial Services Committee Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets hearing entitled The End of Libor, Transitioning to an Alternative Interest Rate Calculation for Mortgages, Student Loans, Derivatives, and Other Financial Products. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, members of the full committee who are not members of the subcommittee are authorized to participate in today's hearing. As a reminder, I ask all members to keep themselves muted when they are not being recognized. The staff has been instructed not to mute members except when the member is not being recognized and there is inadvertent background noise. Members are reminded that they may only participate in one remote proceeding at a time. If you are participating today, please keep your camera on. If you choose to attend another remote proceeding, please turn your camera off. I will now recognize myself for a 4-minute opening statement, after which we will hear from Mr. Huizenga, our ranking member. In a way, this is a test to see whether Congress can pass necessary legislation that isn't Democratic, isn't Republican. It deals with there are $200 trillion of business loans, of home mortgages, of other instruments that have adjustable interest rates that are keyed to the London interbank rate. As of January of next year, 2 of the minor London interbank rates will no longer be published. And as of June of next year, none of the London interbank rates will be published. So you start with $200 trillion of instruments. 99% of the problem we don't have to deal with because many of these instruments are short-term and they'll expire before next year. And a lot of these instruments were drafted with the foresight to recognize that there's a possibility that the London interbank rate would not be published, and the parties have agreed what to do under those circumstances. So we're dealing with a mere 1%, but that mere 1% is $2 trillion of instruments. These instruments were drafted, and the parties agreed without anticipating that Libor would no longer be published during the term. Now this, I don't want to minimize this. This is still $2 trillion. Jay Powell of the Fed has told us that this is a systemic risk to our entire economy. And in the last 2 months, both the chair of the Fed and the Secretary of Treasury have testified before our committee saying that federal legislation is necessary. What federal legislation? There's been a bill in Albany in New York. I've circulated draft number 1, and just this week I've circulated to members of the committee discussion draft number 2. These bills are substantively identical, and we're still fine-tuning the drafting, and I look forward, I'm glad that Mr. Huizenga has agreed to work with me on that final drafting, and I look forward to working with him to get this bill adopted. Some 30 organizations have written to our committee saying that we need legislation along the lines of these discussion drafts. These are groups that don't always agree. We have supporting this approach is the Americans for Financial Reform and the National Consumer Law Center, the U.S. Chamber, the Structured Finance Association, and Sfma. Finally, you might ask, well, why not just have the states do it? 5 reasons. First, some states won't. Second, you get into choice of law litigation, where you may have the borrower in one state, the lender in a second state, and the security for the loan is in a third state. If they have different rules, different amounts to be paid, we can litigate instrument by instrument, not an efficient approach. Third, we would leave our lenders with 51 different systems to deal with. That's expensive and unnecessary. Fourth, no state has jurisdiction where the Trust Indenture Act of 1939 is applicable. So even if we got all 51 states to act, and even if they were consistent, we would still be leaving hundreds of billions of dollars outside the solution. And finally, some instruments are in effect in two levels. You may have a mortgage-backed security subject to New York law, which is an investment in a pool of mortgages which are subject to 50 different state laws depending upon where the home is located. We need federal legislation, and I look forward to working with the members of this committee to achieve it. And we need to act soon because the legislation drafts then have regulators having to adopt regulations, and that will take some time as well. And we've got to get it all done this year. With that, I recognize for 5 minutes the ranking member, Mr. Huizenga.
Thank you, Mr. Chairman, and I do appreciate you having this hearing. And as you had pointed out, as of late, we have had some of those regulators who have acknowledged the need for a federal approach. They had not been so enthusiastic about that until more recently. And as you had indicated, this isn't necessarily a Democrat or a Republican issue, but I will note that it does need to be open to input. So there isn't a party attached to this, but there is a need for input on that. And I'm going to skip over some of my remarks because I know that those times are going to be short here. But as you point out, when we have over 223 trillion with a T, which by the way is even more than what we've been spending lately, that's a huge amount of money. And when we have that, these exposures that are in derivatives, corporate bonds, business loans, secured products, commercial residential mortgage loans, credit cards, student loans, auto loans, a lot of things are tied to LIBOR. And obviously, to date, what we saw in 2008 with the London whale, there's not been $9 billion in fines that have been levied here in the UK, the European Union, and so there's a lot of agreement that this was a benchmark that couldn't continue, and there have been comprehensive reforms, which include designating a new lead regulator for LIBOR in addition to new governance, oversight, technology for the benchmark. However, despite these reform efforts in both the U.S. and UK, LIBOR is increasingly relied on market and transaction data-based expert judgment, close quote. So in response to the recommendations and objectives set forth by FASB, Financial Stability Board, the Financial Stability Oversight Council, FSOC, and to address continued risks related to the U.S. dollar LIBOR, Federal Reserve Board and the Federal Reserve Bank of New York jointly convened the Alternative Reference Rates Committee, or ARC, in 2014. ARC was tasked to identify, quote, risk-free alternative reference rates for U.S. dollar LIBOR, identified best practices for contract robustness, and to create an implementation plan with metrics of success and a timeline to support an orderly adoption, close quote. That's, I think, all good. When 2017, ARC announced the Secured Overnight Financing Rate, or SOFR, its recommended alternative to the LIBOR. And SOFR is an overnight interest rate based on Treasury repurchase transactions or overnight corporate loans secured by U.S. Treasury securities. And unlike LIBOR, SOFR is calculated based on interest rates charged in real transactions in the U.S. Treasury repo market. So one of the biggest challenges that we have with transitioning away from LIBOR is the thousands of existing legacy contracts that extend beyond 2023 and reference LIBOR, but do not contain contractual, quote, fallback language that allows for the contract to be amended and continue to function should LIBOR be discontinued. It's estimated that as of the fourth quarter of 2020, there are $223 trillion in outstanding exposures to U.S. dollar LIBOR. 74 trillion in contractual notional value will remain outstanding after LIBOR's discontinuation June of 2023, and this includes approximately $69 trillion in derivatives and approximately $5 trillion in cash products. So some of these parties have begun incorporating fallback provisions, but it looks like as we transition away, this slow transition away, both Treasury and Federal Reserve officials have called now for federal legislation to assist in the smooth transition. And so I'm looking forward to hearing from the witnesses today Mr. Chairman, we do need to work on this together with the input not only of industry and those that are affected, but those of us that have been elected to act as that speed bump at times to make sure that we're heading in the right direction. And I, for one, want to make sure that the Federal Reserve is, and not just the New York Fed, but the Federal Reserve, it seems to me, may need to have a piece of this rather than it just being the New York Federal Reserve. We need to know that we need to make sure that any of the federal legislation provides market stability as well as to preserve market liquidity. So with that, I think my time is expiring, but I do look forward to working with you in a cooperative manner. So I yield back.
Bill, couldn't agree with you more. Trillion here, a trillion there. It can add up to real money. I now recognize the chair of our full committee, the gentlewoman from California, for 1 minute.
Thank you so very much, Chair Sherman. You've been talking about LIBOR to anybody that would listen to you for over a year or so now, maybe longer than that. And I'm so pleased that you're holding this hearing. Trillions of dollars of consumer contracts ranging from mortgages and student loans to securities contracts are currently tied to LIBOR, which will cease as a reference rate in 2023. As a result, these contracts will have to use another rate. LIBOR proved to be easily manipulated when banking authorities around the globe found excessive collusion by megabanks like JP Morgan, Citigroup, Barclays, Deutsche Bank, UBS, and the Royal Bank of Scotland to fix the LIBOR to their own advantage. These institutions paid billions of dollars in fines to settle their fraud. But now we need to protect consumers, investors, and the United States financial system as the markets transition away from the LIBOR. Thank you. And I yield back the remainder of my time.
Thank you, Madam Chair. Today, we welcome the testimony of our distinguished witnesses. First, we have Dan Coates, who is the Senior Associate Director for the Office of Risk Analysis and Modeling at the Federal Housing Finance Agency, Fhfa. Our second witness will prove that our subcommittee can attract more Coates than any other subcommittee meeting this week. We have John Coates, no relation, who is acting director for the Division of Corporation Finance at the SEC, the Securities and Exchange Commission. Our third witness will be Brian Smith, who is Deputy Assistant Secretary for Federal Finance at the U.S. Department of Treasury. Our fourth witness will be Mark Vanderweed, who is the General Counsel at the Board of Governors of the Federal Reserve System. And I want to thank Mr. Vanderweed for his help in drafting what is now discussion draft 2, which I've circulated this week. And finally, we will have Kevin Walsh, who is Deputy Controller for Market Risk Policy at the Office of Controller of the Currency. Witnesses are reminded that their oral testimony will be limited to 5 minutes. You will be able to see a timer on your screen that will indicate how much time you have left, and a chime will go off at the end of your time. I would ask that you be mindful of the timer and quickly wrap up your testimony if you hear the chime, so that we can be respectful of both the witnesses and the committee members' time. Without objection, your full written statements will be made part of the record. I now recognize Dan Coates for 5 minutes.
Good afternoon, Chairwoman Waters, Chairman Sherman, Ranking Member Huizenga, and members of the subcommittee. I appreciate the opportunity to testify before you today. I serve as the Senior Associate Director of Risk Analysis and Modeling in the Federal Housing Finance Agency's Division of Federal Home Loan Bank Regulation. FHFA regulates and oversees Fannie Mae, Freddie Mac, and the Federal Home Loan Bank System. Since 2008, FHFA has served as conservator of Fannie Mae and Freddie Mac, together the enterprises. Since completing my PhD in economics, I have served in the federal government for over 30 years. Today marks my first time testifying before Congress. At FHFA, I lead an office of economists and financial analysts supporting our examination, supervision, and regulation of the federal home loan banks. Since the 2017 announcement of LIBOR's future discontinuation, I have led FHFA's Libor transition efforts as it oversees the transition of its regulated entities. Libor has been the world's most widely used interest rate benchmark. Preparing for this transition has been and will continue to be an enormous undertaking with a variety of implications for all participants in the global financial system. FHFA and its regulated entities have been leaders in this effort, and I am proud of what we have accomplished to date. As Director Calabria has made clear, FHFA's efforts to transition away from Libor are guided by the same core principles that direct all the agency's work: ensuring the safety and soundness of our regulated entities, supporting liquidity and resilience in our nation's housing finance markets, and protecting homeowners and renters. While important work remains, I am confident that we will meet our goal of fully transitioning the enterprises and the Federal Home Loan banks away from Libor before the end of 2021. When this effort began, Libor was the reference rate for the vast majority of financial products central to the operations of FHFA's regulated entities. Such products included enterprise and Federal Home Loan Bank system debt, Federal Home Loan Bank advances, derivative transactions, mortgage-backed securities, collateralized mortgage obligations, credit risk transfer transactions, and adjustable rate mortgages, known as ARMs. Our challenge was to ensure our regulated entities transition to robust reference rates for all of these products and for the related internal systems of the regulated entities. FHFA supports and its regulated entities have adopted the ARC's recommended replacement rate as being the best suited for this transition away from Libor. There are a number of contracts that did not contemplate the permanent cessation of Libor. Disputes over the interpretation of these contracts will likely be lessened with the passage of federal legislation to provide clarity about the transition. While FHFA is open to any robust reference rate that meets the principles of the International Organization of Securities Commissions and is fit for purpose, the time remaining to prepare for this transition is getting short, and FHFA does not support a wait-and-see approach to this transition. While the date of the Libor cessation has recently been extended for most US dollar Libor maturities until June 30th, 2023, FHFA has continued to ensure our regulated entities are ready for the Libor cessation by the end of this year. The actions FHFA has taken since 2018 to prepare for this transition are consistent with the guidance issued on November 30th, 2020 by the Federal Reserve, the OCC, and the FDIC, who stated their concerns that continued new Libor use after the end of 2021 would create safety and soundness risks. Thanks to FHFA's leadership, the Federal Home Loan banks and the enterprises are moving prudently away from Libor. As of July 2020, the Federal Home Loan banks have ceased entering into Libor transactions with maturities beyond 2021. As of December 31st, 2020, the enterprises are no longer purchasing Libor-indexed ARMs or issuing any Libor-based mortgage products. They are now purchasing SOFR-based ARMs and issuing SOFR-indexed mortgage-backed securities and other mortgage products. FHFA's regulated entities have led the Libor transition as the first and most significant issuers of SOFR-indexed debt and as developers of SOFR-based alternatives to their existing Libor products. At FHFA, we continue to look for ways we can enhance awareness of the importance of this transition. I'll be glad to answer your questions.
Thank you, Mr. Coates. And we now recognize John Coates for 5 minutes.
Thank you, Chairwoman Waters, Chair Sherman, and Ranking Member Huizenga, and members of the subcommittee. I appreciate the opportunity to testify today about the transition away from Libor and the efforts of the staff of the Securities and Exchange Commission to monitor that transition in furtherance of the Commission's missions, which are to protect investors, maintain fair and orderly markets, facilitate capital formation. The announced discontinuation of Libor and the transition to one or more alternatives will have significant impacts on the financial markets and on market participants, and it may present material risks for both public companies and their investors, as well as SEC-supervised entities. Those risks will be greater if an orderly transition is not completed in a timely manner, including important work to be done this year and beyond. A cross-agency team of staff at the Commission has been collaborating regularly on transition matters, and the staff is actively monitoring the extent to which market participants are identifying and addressing risks and preparing for the transition. In the division that I currently help lead, the Division of Corporation Finance, we've been encouraging public companies to plan for the transition and consider their disclosure obligations and the risks that the transition may present to their businesses. We specifically encourage companies to inform investors about risk identification and mitigation, as well as any anticipated material impacts of the transition, which may particularly affect companies who face financing constraints. Companies may also need to reflect the transition in their information technology systems, their internal controls, their policies and procedures. The back office, which sometimes gets neglected, is going to be very important in this transition. A second division at the SEC, our Trading and Markets Division, has been monitoring the impacts of the transition on brokers, counterparties, and exchanges. These impacts may arise due to being a party to transactions referencing LIBOR, making a market in those instruments, underwriting, placing, or advising on them. And the impact can have several different channels for how they affect these firms on their businesses and systems. Valuation models are going to have to be changed, business processes, and risk management frameworks. And ultimately, these firms serve clients who also are going to be affected. A third division at the SEC, our exams division, has been assessing the impact on entities that we oversee. Last year, performed roughly 75 exams of a wide range of registrants with a focus on identifying challenges from the transition. Exams has also provided guidance for how to plan for and carry out a successful transition. And as with our other efforts, that exam work is ongoing. Preparation and risk management by investment advisors and funds is performed by our Division of Investment Management. That division has been encouraging advisors to consider the effect of the transition on LIBOR-based instruments, which are held by mutual funds, which are in turn, of course, held by millions of retail investors. Investment management has been providing guidance to encourage funds to provide tailored disclosures about the transition and how it interacts with their investment objectives, holdings, strategies, and structure. Finally, two of our offices have been also involved in LIBOR-related work, our Office of Chief Accountant and the Office of Municipal Securities. And let me just say, it's nice to be testifying before a chair who has an accounting background, which is a central focus of my division. Our chief accountant continues to monitor the activities of preparers and auditors, standard setters, and other regulators to address the financial reporting issues related to the transition. The staff of the chief accountant has been having ongoing discussions with various stakeholders and supported efforts to raise awareness of the accounting side of the transition. And we note that the FASB and the IASB have continued to update their standards to reflect ongoing changes throughout the transition. Not the last but not least, our Office of Municipal Securities has been encouraging municipal issuers and advisors to focus on those issues directly relevant to the municipal market, which is also important to retail. Thank you for the opportunity to testify here today.
Thank our witnesses for limiting their comments to 5 minutes, and we now recognize Mr. Smith for 5 minutes.
Thank you to Chairwoman Waters, Chair Sherman, and Ranking Member Huizenga. I appreciate the opportunity to testify at this hearing on this important issue. As Treasury's Deputy Assistant Secretary for Federal Finance, I oversee the department's work on the LIBOR transition. Though LIBOR is used in more than $200 trillion of outstanding financial contracts today, 2 tenors of USD LIBOR will cease being published at the end of 2021, and the remainder will cease by June 2023. LIBOR's widespread use in the financial system, but short remaining lifespan, underscores the urgency of a timely and effective transition. In recent years, LIBOR has played an active role, Treasury has played an active role in highlighting the risks associated with the continued use of LIBOR and encouraging a market participant-led transition. Since 2013, annual reports of the Financial Stability Oversight Council, which the Treasury Secretary chairs, have called attention to the LIBOR-related financial stability risks, encouraged market participants to formulate and execute their transition plans, and recommended that member agencies use their authorities to facilitate transition. Treasury has served as an ex officio member of the Alternative Reference Rates Committee, or ARC, since that group was convened in 2014 by the Board of Governors of the Federal Reserve System and the Federal Reserve Bank of New York. The ARC is composed of a diverse set of private market participants working towards successful transition away from LIBOR. As an alternative to LIBOR, the ARC has recommended the Secured Overnight Financing Rate, or SOFR, which is a robust rate based on nearly $1 trillion in daily transactions. The ARC has also recommended robust contract fallback language for various financial products and worked closely with regulators to identify and tackle potential roadblocks to transition. Treasury applauds the passage of LIBOR transition legislation in New York State, which will provide meaningful relief for the transition of legacy contracts written under New York law. In addition, Treasury has also taken initial steps to address the potential tax consequences of modifying contracts that reference LIBOR, although some of the relevant tax statutes lack a grant of regulatory authority, which limits the tax relief that Treasury can provide. Despite this important progress, challenges for the transition remain, and federal legislation is needed. As Secretary Yellen described in recent testimony before the House Financial Services Committee, legislation is necessary for so-called tough legacy contracts that do not specify a workable fallback rate and are not feasible for private sector actors to modify on their own. Federal legislation could also ensure that Treasury has sufficient authority to address the tax consequences of the LIBOR transition and amend the Higher Education Act of 1965's reference to LIBOR for special allowance payments under the Legacy Guaranteed Federal Student Loan Program. With LIBOR secession dates approaching quickly, market participants must make progress on transitioning contracts where feasible, and new contracts should begin referencing alternative rates like SOFR. In addition, in the case of consumer loans, it is imperative that lenders engage with consumers about how this transition will affect them and provide them with timely notice of any changes. Lenders need to act responsibly so that consumers are not caught by surprise. With that, I'll conclude my remarks. Chair Sherman and Ranking Member Huizenga, thank you again for your interest and your engagement on this important issue, and I look forward to your questions.
Thank you for your brevity, and I now recognize Mr. Vanderweed, and I want to thank Mr. Vanderweed for his help in drafting discussion draft number 2, and you are recognized for 5 minutes.
Chairman Sherman, Ranking Member Huizenga, and members of the subcommittee, thank you for the opportunity to appear today. My testimony will discuss the importance of ensuring a smooth, transparent, and fair transition away from LIBOR to more durable replacement rates, as well as some of the challenges posed by this transition. Before I delve into these issues, however, it may be helpful to review how LIBOR is used and why it will be discontinued. LIBOR measures the average interest rate at which large banks can borrow in unsecured wholesale funding markets. Over the past few decades, LIBOR became a benchmark used to set interest rates for commercial loans, mortgages, derivatives, and many other financial products. In total, US dollar LIBOR is used in more than 200 trillion of financial contracts worldwide. By now, the flaws of LIBOR are well documented. A fundamental deficiency is that LIBOR has been based on thinly traded markets, which has made the rate vulnerable to collusion and manipulation. Following the exposure of these weaknesses and the imposition of material, large legal penalties on a number of firms and individuals that engaged in LIBOR misconduct, most of the LIBOR panel banks determined that they would not continue making LIBOR submissions. Last month, LIBOR's UK regulator announced that the 1-week and 2-month US dollar LIBOR rates will cease to be published at the end of 2021, while the remaining LIBOR rates will cease to be published on a representative basis in mid-2023. This definitive announcement about the end of LIBOR underscores the importance of moving away from this moribund benchmark rate. Market participants, regulatory agencies, consumer groups, and other stakeholders have put in a great deal of work to prepare for life after LIBOR. To promote a smooth transition away from the rate, the Federal Reserve convened the Alternative Reference Rates Committee, or ARC, in 2014. Recognizing that the private sector must drive this transition, the ARC's voting members are private sector firms. In 2017, the ARC identified the Secured Overnight Financing Rate, or SOFR, as its recommended alternative to US dollar LIBOR. SOFR is a broad measure of the cost of borrowing cash overnight, collateralized by Treasury securities. Unlike LIBOR, SOFR is based on a market with a high volume of underlying transactions, regularly around $1 trillion daily. Market participants are not required to replace LIBOR with SOFR in their financial contracts. Importantly, the Federal Reserve and the other federal banking agencies issued a statement last year to emphasize that a bank may use any reference rate for its loans that the bank determines to be appropriate for its funding model and customer needs. The statement also noted, however, that a bank's loan contract should include robust fallback language. The Fed's supervision of LIBOR is strengthening. In November of 2020, the Federal Reserve, the OCC, and the FDIC sent a letter to banking firms noting that the continued use of US dollar LIBOR in new transactions after 2021 will create safety and soundness risks. Accordingly, we have encouraged our supervised entities to stop using LIBOR in new contracts as soon as practicable, and in any event by the end of this year. Vice Chair Quarles has emphasized in a recent speech that banking firms should be aware of the intense supervisory focus the Fed is placing on the LIBOR transition. The key question for policymakers is whether legacy LIBOR contracts can seamlessly switch over to alternative reference rates when LIBOR ends. The ARC recently estimated that roughly 1/3 of legacy contracts will not mature before mid-2023. Some of these legacy contracts have workable fallback language to address the end of LIBOR, but others do not, which may result in significant litigation. Chair Powell and Vice Chair Quarles have publicly stated their support for federal legislation to mitigate risks related to legacy contracts. Federal legislation would establish a clear and uniform framework on a nationwide basis for replacing LIBOR and legacy contracts that do not provide for an appropriate fallback rate. Federal legislation should be targeted narrowly to address legacy contracts that have no fallback language, that have fallback language referring to a version of LIBOR or to a pool of banks, or that effectively convert to fixed rate instruments. Federal legislation should not affect legacy contracts with fallbacks to another floating rate, nor should it dictate that market participants must use any particular benchmark rate in future contracts. Finally, to avoid conflict of laws problems, federal legislation should preempt any outstanding state laws on legacy LIBOR contracts. Thank you. I look forward to your questions on this important matter.
Thank you. And we'll now go on to Mr. Walsh, who's recognized for 5 minutes.
Chairwoman Waters, Chairman Sherman, Ranking Member Huizenga, and members of the subcommittee, thank you for the opportunity to discuss the OCC's work to ensure the large, mid-sized, and community banks we supervise are prepared for the cessation and replacement of the London Interbank Offered Rate, or LIBOR. I am Kevin Walsh, Deputy Comptroller for Market Risk Policy. I am the OCC's ex officio member of the Alternative Reference Rate Committee, oversee the agency's representation on other committees associated with LIBOR cessation, and oversee the development and interpretation of policy and guidance related to market risk facing the federal banking system. The OCC has worked closely with the institutions we supervise to ensure their preparedness since 2018. To avoid the risk of market disruptions, prolonged litigation, and adverse financial impacts, the OCC has stressed to banks we supervise the importance of adequate transition planning and successfully executing those plans before LIBOR ceases to be reported. The OCC's mission is to ensure that the institutions we charter and supervise operate in a safe and sound manner and treat all customers fairly. Rather than endorse any specific replacement rate, including the Secured Overnight Financing Rate, or SOFR, we want to ensure that banks have the flexibility to determine LIBOR's successor rate or rates as may be most appropriate for the continued operation of their business model and risk appetite and the function that rate supports in a safe and sound manner. Starting in 2018, as part of our ongoing outreach sessions with bank CEOs, CFOs, chief risk officers, and bank directors, we included discussions of LIBOR cessation and encouraged them to consider their exposures, risk tolerances, and mitigation plans. We first mentioned the need for LIBOR transition plans in our semi-annual risk perspective that year. Since then, we have published several bulletins and guidance documents that set forth our expectations for bank transition activities. In November 2020, the OCC published a joint letter with the Federal Reserve and the FDIC that reiterated that a bank may use any reference rate it determines to be appropriate for its business model and customer needs. That month, the OCC and other banking regulators clarified expectations that banks must stop creating new LIBOR exposures by the end of 2021, with few exceptions. Recently, the OCC published a self-assessment tool that includes a series of questions related to bank exposure assessment and planning, consideration of replacement rates, fallback language, and the bank's overall LIBOR cessation preparedness. The tool will help bank management evaluate, identify, and alleviate transition risks. To date, more than 95% of the institutions we supervise have gone through the process to quantify their exposures. For smaller community banks that engage in LIBOR-based lending, such as commercial or residential real estate lending or small business loans, the transition process may present operational challenges that banks will need to address based on their resources, the scope of their exposure, and the relative financial sophistication of their borrowers. OCC is working closely with these banks to assist them in mitigating these challenges. OCC examiners are also supporting the regional and largest banks address their LIBOR-based exposures and are actively monitoring the adequacy of their planning and implementation of their mitigation strategies. My testimony describes how new ISDA protocols and a recently enacted New York state law have significantly reduced the risk of market disruption in the derivatives market. Mitigating risks within consumer loan products and securities portfolios will be more complex given the nature of those instruments. Loans are typically negotiated between parties, and the applicability of a variety of state laws can make negotiations more complicated. Securities, notably securitized exposures, are complicated by the diverse investor bases that need to provide agreement to make changes to the rates. Banks continue to work on preparing these portfolios for the transition, and the OCC is closely monitoring their efforts. To further assist with the transition, the OCC appreciates Congress's efforts to clarify contracts that do not have a fallback provision or a new rate as is designated in the draft Adjustable Interest Rate LIBOR Act of 2021. Legislation could be helpful in addressing systemic risks associated with the LIBOR cessation by incentivizing financial counterparties to agree to an appropriate reference rate or otherwise designating SOFR as the replacement rate. The OCC has provided comments to staff and looks forward to working with the subcommittee to perfect the legislation. Thank you again for inviting me to appear today. I will be happy to answer your questions.
Thank you. We'll be conducting this hearing while there's voting going on the floor. I have been told that Mr. Kasten will be back within 10 minutes, which will give me a chance to rush to the floor to vote. I'll now...
Mr. Chairman, this is Bill Huizenga. Just a point of clarification. You do not intend to halt the hearing, correct? You're just expecting this to go on an ongoing rolling basis, correct?
Exactly. Out of respect for our witnesses' time, I'm hoping that members can vote and come back and that they'll be available when they're called on, when we'll go on. If they're not, we'll go on to the next member from the respective party.
And is there any indication? I know that recently votes were changed to a 30-minute window. I know we have 14 votes today. Are we anticipating that those are going to continue to be 30-minute votes for each one of those, or are you aware of leadership tightening up that time, which may make this a little more challenging to do this on an ongoing rolling basis?
The rules are 30 minutes. In the past, they've been 40. 30 has meant 40. My guess is that 30 today will mean 30, but there's no change in the official policy.
Okay, thank you.
And I'll remind members that the tape of this hearing will be available. So if you miss part of it, and you can go back and watch it late tonight. Or you can watch it while we're waiting for the 13th and 14th vote later in the evening. I'll now yield myself 5 minutes. I want to thank Mr. Vanderweed for pointing out that the discussion drafts honor the sanctity of contracts with the 90% plus of contracts that were written in anticipation of the possibility that LIBOR would no longer be published. That these discussion drafts involve inserting government only where the parties didn't make an agreement that can be carried out. And I want to thank Mr. Walsh for pointing out the operational challenges that will face particularly small and medium-sized institutions. If we end up with 51 different rules, small banks may not do business in the District of Columbia and 50 states, but many of them have loans on their books for one reason or another in 5 or 10 different places and could easily find themselves facing real operational difficulties. I now have a question for each one of our witnesses, and I'm hoping to get a simple yes or no answer to, and I'll go down the list. The question is it important that we promptly adopt federal legislation to provide a statutory fix for LIBOR-based contracts that lack sufficient background language? Mr. Dan Coates, is it important?
Yes. Yes, we believe it is important to have a federal.
Mr. John Coates. Mr. John Coates?
Yeah, I'm trying to get off mute. So the commission has not taken a position formally on legislation, but we are supportive of efforts to increase the stability of the markets, and we stand ready to support your efforts in this legislation.
That's as close to a yes as you can get until your new chair takes over. Mr. Smith?
Yes, Secretary Yellen has indicated support for the federal legislation.
Mr. Vanderweed?
Yes, thumbs up.
And Mr. Wall?
We think it's constructive.
Thank you. Mr. John Coates, in the absence of a clear solution for LIBOR-based contracts as we get closer to June 2023, I imagine we're going to see increased price volatility or a discounting of those instruments that lack clear fallback language. Is that something that we would expect, where two contracts that look identical will be trading differently because one has a good fallback language in it, but the other one doesn't?
I think that's a fair prediction. I think any risk, including litigation risk, can affect pricing and could create discrepancies in pricing. I think that's correct.
Now, Mr. Vanderweed, I've got a question for you about timing. Each proposal, whether it's the one from Albany or the two that I've circulated, all involve the idea of a agency writing a regulation. So first you need the legislation, then you get the regulatory process. So how much time do we have to adopt legislation, have it signed into law, so that then the Fed can adopt regulations that will solve this problem?
I do think it's important that we have a regulatory agency with the ability to write regulations to implement the legislation. There are going to be a lot of complicated operational issues, and it'll be useful to have an agency that can do the interstitial work to plug those holes. That does mean I think it is important for Congress to act expeditiously to get the legislation passed. I don't have a deadline to give you, but as you know, the important LIBOR tenors are going to be going away in mid-2023. You will want to give an agency some time to write the rule. So, decently well in advance of June 2023, we want to have Congress having that legislation passed.
My staff calculated that you need 240 days to adopt regulations. Is that right, or can you do it more quickly? Or optimally, would you have 240 days? And how much less could you live with?
Optimally, yeah, I think having 8 months would be great. But if we need to do it a little faster than that, I'm sure we can do it a little faster than that.
Okay. Well, my hope is that we have this signed into law, hopefully before Halloween. Otherwise, it starts to get scary on financial markets. And I'll add another question for you. Oh, my time has expired. I'll now recognize for questions, Mr. Huizenga.
Thank you, Mr. Sherman. And let me start with my fellow Dutchman being chair of the Dutch caucus. This is an important clarification, whether it's Vander Weide, as we would say in West Michigan, or Vander Weed. Feel free to clarify. But I do have a question for you. How does the New York state legislation only, does the New York state legislation only fix the New York problem, or does it impact some of those other contracts across the country? And what happens in absence of any federal intervention? And you're on mute. Sorry, we need you to come off mute. Still can't hear you, sir. Mr. Chairman, I'm hoping that we're going to be able to add a little time back onto the clock.
We'll add 20 seconds back.
Well, it was about 40 that it was going, but anyway.
We'll add 45 seconds
Okay,
back,
whatever.
which means you now have more than 5 minutes. Go on.
All right.
Mr. Ben?
I don't. If he's speaking, I'm sorry, I can't look like it.
Can I? Can
Well, let me move on, and hopefully we'll be able to get back to Mr. Vanderweide or for that clarification on his name pronunciation. But to everybody, I guess the yes/no answer that the chairman asked, I think is a good one. But let me add some maybe a little more pointed. In your support of this, is it this specific language that we have before us, or is it the concept of federal legislation needing a response? And why don't we start off with the two Mr. Coates?
Congressman, we support any federal legislation to smooth the transition. We stand ready to help you and your colleagues.
So it's more the concept, we need to address it.
Yes, sir.
Correct. Okay. Mr. Coates, I think John.
Yes, thank you. It's the same answer as before, which is we're supportive of efforts to increase the stability of the markets.
Okay.
And that applies regardless of the particular language.
Okay. And Mr. Walsh, I detected a hint of a little more reticence on your part. I don't know whether that was intentional or me reading into it. But the question I have for you is that the concept of the need for federal legislation or this specific language, and then do you foresee any conflict in using SOFR?
Well, to answer the first part of your question, Congressman, we think that federal legislation is very constructive, and we have offered comments to staff and would be very happy to review those comments with staff and work to perfect the legislation moving forward. No, we don't see there's any issue or problem with SOFR, but the scope and spectrum of banks that the OCC supervises is extraordinarily diverse, from the largest globally acted, most complex financial institutions down to small community banks that operate in a very local way. And their needs are different. And we want to respect that and give them the opportunity to use any replacement rate that they think fits their business model, their risk appetite, and is appropriately approved through their internal processes for risk management.
So let me ask you, what happens in the absence of federal intervention?
I think that in the absence of federal legislation, that there is the contracts that don't have fallback language could be very problematic. And there are also a large number of contracts that require 100% of investor base agreement that we do not think is operationally executable.
Is the shorthand of that answer litigation?
Yes.
Okay. All right. Preemption. We all know state law governs private contracts made in that state. Federal legislation providing a fallback language for these tough legacy contracts is essentially amending these contracts governed by state law, retroactively inserting fallback provisions. And so what it sounds like is we're needing to preempt state law to a degree, correct? Either Mr. Coates or, I don't know if Mr. Vanderwhite's back on.
Well, here at the OCC, we think that it's very important that there be consistency across all of the markets, and that federal legislation can help propel that consistency.
Yeah, well, one of the concerns, and I've got closing seconds here, in an effort to avoid litigation, I'm afraid that we may be susceptible to litigation challenging the constitutionality of interfering with these private contracts under the takings clause of the Fifth Amendment. So does anybody else have any concerns about that? Either the Mr. Coates or yourself, Mr. Walsh?
I would defer to those trained in the law to answer that question.
Mr. Coates or Mr. Walsh in the closing seconds?
What I would say is I think that we can work at a technical level to try to minimize that risk. And I think you're right that there's risk of litigation no matter what. And the question is how best to minimize it to the greatest extent we can.
All right, thank you. I appreciate the extra time there, Mr. Chairman.
Well, I see
And
Mr.
while I think both you and I are leaving to go vote, I'm assuming that we've got coverage from some capable colleagues of ours, correct?
Mr. Kasten has proven that he can get back just in time. I'm turning over the gavel to him. And as to the constitutional matter, I will point out that the Contracts Clause of the U.S. Constitution limits the power of state governments, not the power of the federal government, although the sanctity of contracts is an important principle. It's not as constitutional a principle when federal government takes action. With that, I yield to Mr. Kasten, both for his questions and for his service as acting chair.
Thank you very much, Mr. Sherman. I'm not sure how I got bumped in the queue, but I guess with great power comes great responsibility. Or something like that.
I believe it's because others aren't there. If there is a more member of the subcommittee.
Well, hey, perfect. I'll take it, and I will watch for staff letting me know who's next in the queue. Thank you to all our witnesses, and I want to echo what Chair Sherman said at the start. This is one of these issues that is thankfully so bloody complicated that it's nonpartisan. So I hope you'll forgive my maybe lack of education on this issue, but I just like to understand. I think I understand what we are doing, or at least what the fulcrum of issues are on the day after LIBOR ends. And what I'm curious for you guys' view on is to what degree do we need to be concerned about the days before it ends? And specifically, there's a robust swaps and futures market, and all the folks who are hedging out their LIBOR risk. We know that LIBOR has been gameable. Presumably, the liquidity in those swaps and futures markets is going to start shrinking as we get sort of close to D-Day. Is there sufficient vigilance from a regulatory perspective for that period? Is there anything we should be watching for? And if the answer is that's a dumb question, Kasten, that's an acceptable answer as well. I'm asking out of curiosity. And I'm happy to, any of you who have thoughts on that, it's not directed to any particular witness.
Well, here at the OCC, we've had a very well thought out and aggressive program in our supervision activities with respect to LIBOR cessation and transition since 2018. It was a phased approach. In the first period, we focused on awareness, communicating that LIBOR was ending and that banks that we supervise need to do an inventory and understand their risk exposures. In the next phase, we added preparedness, where we worked closely with the banks. I mentioned in my opening statement the LIBOR self-assessment tool that we first published as guidance to the banks we supervise, and more recently have made public for the entire financial institution community to use. It's a checklist, a series of over 30 questions to identify risks that they might have. And finally, now we're moving into a phase where we will be very actively examining banks to determine the level of preparedness that they have. So we think that we're very well along in terms of the before the end date tasks that have to be undertaken.
Okay, but you're satisfied that those forward futures and swaps are those markets will stay robust as long as we need them to stay robust and sufficiently liquid?
Yes, I do.
Okay. So the second question is, I come from the utility industry before I got here. And you know, you have a lot of contracts in that industry, like a lot of industries that are where you've got cost pass-throughs onto your customers. And in the context of a borrower and a lender, I think I understand where the fulcrum of the issues are here. But presumably there are some quantum of borrowers who have downstream contracts where they can pass this risk along as it moves. And I'm just curious whether there is any lingering, if we don't mandate that everybody switches to a fixed product, to the extent that some borrowers have the ability to pass that, whatever resulting risk is, onto their customers. Do we need to be vigilant about that? Is there even any way to quantify how big that risk is? Because you'd have to start looking into a lot of downstream contracts beyond the pure banking contracts. But I presume there's a decent number of those pass-through contracts out there. Has anybody looked into that or understood it, or am I barking up a short tree? And again, happy to anybody who's got thoughts on that question.
In the absence of someone else answering, let me just offer that that actually litigation is hard to pass through. I mean, in the sense, there are ways you can do it, but if you're the direct party, even if you have a perfectly matching ability to recover on the economics, if you end up in litigation because the terms of that first security are uncertain, you're going to be in litigation. So there is actually a kind of, regardless of the economics of the position of that contract in the overall market, you do have an incentive to look for clarity in what has to be paid.
And I guess I'm not thinking that you would ever have a right to pass through litigation, but there is if I'm not mandated to go to another basis, and I don't have any particular economic incentive to pick one basis versus the other, is there any risk there that you might just default to? And I don't know. I'm just curious if it's something we should be thinking about.
So that in effect, the terms of renegotiation might not be well considered if the party doing the negotiation. Yeah, I mean, I think that's a fair point for anybody who's supervising those entities.
Okay. Well, apologies for my ignorance, but I do appreciate your time and your willingness to tolerate me. The chair will now recognize Representative Wagner from Missouri.
Thank you, Mr. Chairman. Mr. Smith, will you describe the steps that the Treasury Department has taken and is taking to facilitate the transition from LIBOR?
Yes, thank you for that question and your interest in this important issue. The Treasury Department has taken several steps regarding the transition away from LIBOR, all with the goal of trying to ensure a smooth transition that avoids disruptions of financial markets, as well as for businesses, consumers, and families, who have financial products that are related to these rates. The Financial Stability Oversight Council that the Treasury Secretary chairs has highlighted the risks of surrounding LIBOR and transition for several years now, encouraged market participants to evaluate their exposures and regulators to collaborate on encouraging transition. Treasury is an ex officio member of the Alternative Reference Rates Committee and supported its work to establish robust fallback language in contracts, to consider alternative reference rates like SOFR, and to engage with market participants about their use, encourage them to stop using LIBOR where feasible, and begin using alternative rates if possible. And lastly, the Treasury Department has published tax rules of proposal with Reliance to help manage the tax consequences of the transition away from LIBOR, so that potential tax consequences don't become an impediment to participants who want to transition away.
Thank you very, very much. Mr. John Coates, will you describe the SEC's role in this process and the steps the Commission and its staff are taking to facilitate the transition, please?
Thank you very much for the interest in what we've been doing. And I'll say my written statement outlines this a little bit more than I'll do right now, but at a high level, what we've been doing is to actively monitor the extent to which public companies and other supervised entities of ours are identifying, disclosing, and managing the risks associated with the transition, particularly risks associated with new contracts or tough legacy contracts that extend beyond 2021. We put out some written guidance on how to approach these topics, as well as risk alerts to investors to draw attention to the issues that regulated entities and public companies should all be considering as they engage in the transition.
Great, thank you very much. Mr. Van der Weide, will you describe the differences between LIBOR and SOFR? Oh, I don't think we can hear you. Anybody else want to take a stab? I'm sorry, Mark, I don't think we can. Is it just me?
I can't hear him either, and I'm happy to take that if you'd like.
Please.
So, LIBOR is a survey-based rate. It's constructed by polling a panel of banks and asking them where they can borrow. SOFR is based on transactions in the Treasury repo market, the over market, and it's based on actual transactions, not a survey of where people think they can borrow. And it's based on collateralized borrowing, that is, people borrowing, pledging Treasury securities as the collateral. So, key differences are the transaction base. SOFR has almost $1 trillion of the transactions that occur every day, and they're actual observable transactions that you can see that are actually done. LIBOR is a survey where banks determine, their submission, sometimes based on transactions, but often based on judgment because they have no transactions to reference. I'm sorry, ma'am, I can't hear you.
Sorry, trying to cut down on the background noise. Please, everybody else mute. Given the issues that we had with LIBOR in the past, could you discuss a little bit, Mr. Smith, how SOFR addresses that risk of manipulation, please, in my limited time?
Yeah, the main way is because it is based on that robust set of transactions that are so large and deep and done by such a diverse set of market participants, that makes it very hard to manipulate. The process is also very transparent for taking those transactions, how they're aggregated and calculated in a final number done by the Federal Reserve Bank of New York and done in compliance with IOSCO principles.
Thank you all very much. I appreciate the panel. I appreciate the discussion, and I will yield back.
And if I'm following the grid properly, I believe that in terms of participation, Mr. Foster from Illinois is now up next. Mr. Foster, you're recognized for 5 minutes.
Okay. Well, first I wanted to thank everyone who's been working on this, for a decade. I remember during the financial crisis, you'd wake up every day and check out the LIBOR-TED spread to find out if the world was ending or not. And then to find out, a year or more than a year later, that the whole thing was just sort of made up. It sort of made me a little bit queasy. And so it's nice to see that we're finally, fixing this. I'd like to ask some questions about whether people expect systematic differences in the average rate of the alternative rates. Will LIBOR be higher or lower on average? Who are the winners and losers if it turns out that there are a couple of basis point difference in these?
Can you hear me now? Can you hear me now?
Yes, we can.
Okay, good. Sorry for all the technical difficulties. Yeah, so there may be some differences in the rates, the various different alternative rates that folks use as LIBOR is going away. SOFR, the alternative rate that's been recommended by the ARC, is different in nature, as Brian Smith indicated, than LIBOR. So, for example, daily averages of SOFR will show more volatility than LIBOR, and SOFR will behave a little bit differently in times of economic stress and financial crises than LIBOR will. But in general, the way that SOFR is implemented into contracts is it's done through an average. And the average of SOFR and LIBOR correlate quite closely together. If you look over the last 30 years of data, they correlate quite closely together. So we think in the long haul, there shouldn't be significant categories of winners and losers as people move over to SOFR for derivatives and some other transaction types.
Are they based on averages or medians or?
The version of SOFR that's used in financial contracts is based on an average over multiple days, and that averaging mechanism softens some of the volatility and gets us to, I think, a more attractive result.
Okay, and are there already players in the market betting that we're going to fix this one way or another, and trying to, play the decision that's made in the legislation here, in the shift in the value of some of the, positions that are held on this? Is that something that's happening yet? Or are people just counting on it being continuous and smooth and no disruption?
There are certainly investors out there that are taking positions on the speed and nature of the way we transition away from LIBOR. We're trying to ignore that noise and move forward with LIBOR transition in a way that we think is most publicly useful. But there are certainly various parties out there that are entering into different kinds of contracts to take positions on the nature and the speed of the LIBOR transition process.
Yeah, and what is the structure of such a bet that one might be able to place?
I don't think I have enough expertise to answer that one.
Is there someone else who might have a guess at that?
I guess I would offer that the ARC, in its approach to thinking about fallback, tried to develop a process that was transparent and fair for all participants to avoid that kind of winners and losers type situation by developing in advance a clear laid out approach for what the spread adjustment would be when contracts fell back, having an external party calculate a clear formula for it, and having that triggered at the moment that the administrator of LIBOR announced it would be ceased. So those fallback amounts have already been fixed earlier this year when IBA made that announcement.
And are there specific institutions that have might introduce systemic risk that have special roles in creating any of these rates?
Well, the nice thing about SOFR, one of the many nice things about SOFR, is that it does, as Brian indicated earlier, there's a ton of underlying transactions, and they come from a pretty diverse and large set of financial institutions. So at least the primary alternative to LIBOR, SOFR, is going to be one that's based on a large volume and a diverse set of market participants.
Okay, and who is it that accumulates the data for it? I just looked up something on the web here at the Federal Reserve Bank of New York, and it said that it indicates that somehow, I guess it's Boney Mellon had a special role in calculating the rate. I just was wondering if we're very dependent on specific institutions here, and there may be systemic risk there.
Yeah, I don't think in a problematic way, no.
Okay, well, thank you. Yield back.
The gentleman from Ohio, Mr. Stivers, is now recognized for 5 minutes.
Thank you, Mr. Chair. My first question is for Mr. John Coates. The SEC has an important role to play in ensuring that federal and state LIBOR legislation transition is effective. As you know, the Trust Indenture Act may require unanimous consent of note holders to affect a change in the benchmark interest rate on those transactions. Unanimous consent in practice is impossible to achieve, especially on the scale of tens of thousands of note holders. And this requirement in this unique scenario could harm the investors that the Trust Indenture Act is meant to protect. Therefore, narrow targeted guidance and relief related to the application of TIA might be necessary to reach the end goal of amending contracts in an expedient manner, while at the same time, staving off uncertainty and potential litigation. Mr. Coates, do you think that the SEC will be able and willing to issue some narrow and targeted guidance with related to the Trust Indenture Act and the Libor transition?
So thank you for that question. I think it's a very good question, and it highlights an important difference in the way that state and federal law can respond or anticipate the transition here. It is exactly correct, as you summarized, that the Trust Indenture Act can create problems. The SEC does have an ability to provide exemptive relief under that act. I will note that it would require notice and comment rulemaking, as we understand the role that we would be likely to play, which, as you know, can take some time. And I'll also note that the bill that's, I think, being discussed here would directly address the question as well. So I think we're both ready to help in a technical sense with language in this bill, as well as consider the potential need for exemptive relief if that becomes necessary.
Great, thank you. That's really the only key question I had, and I appreciate everybody's hard work. I appreciate all the witnesses. This is a very important transition for our financial markets. It's important that we get it right. This is not, as the ranking member said in his opening statement, it is not a partisan issue at all. Republicans and Democrats both want to get this transition right, and we stand ready to work with the administration and the SEC and the FHFA and the Federal Reserve in any way we can. I look forward to starting to move this legislation forward. I know that the chair of the subcommittee has been working on this a while and cares a lot about it. With that, I yield back.
It's nice to see a generosity of spirit on the across the aisle and with the clock, which is freeing up so much extra time here.
You're welcome.
The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Mr. Chairman, thank you very much. I appreciate the opportunity to speak. And I also want to thank each and every one of our witnesses today. I don't know if anyone remembers Y2K. Y2K. But I was on the San Diego City Council on the Public Safety Committee, and I remember that New Year's Eve. I've never been so nervous because we didn't know it was going to happen. I remember sitting there at the police department thinking all the lights are going to go off because we were told all these crazy things were going to happen. The street lights were going to go down. All of our signaling for the traffic was going to go down potentially. Police weren't going to be able to communicate with each other. And so I remember sitting there with the chief of police, chief of the fire department, the mayor, and all of us thinking, oh no, let's see what happens. Nothing happened, thank God. And we kept going. And the reason for that was we were prepared. We were prepared. We had worked hard on this and people were prepared. That's the way I see this, to be frank. It sounds like you guys are working hard. You've been working hard. A lot of the 99% of the potential problems seem to have been anticipated and corrected. I mean, this 1% is $2 trillion. That's nothing to sneeze about. But it sounds like most of the issue is old. It said in the movies has been solved. So my question here is, on this last little bit, how really could consumers be heard? What would be the big difference to a consumer if we didn't fix this legislative? I hope that we will, and it sounds like we will. But if we didn't, what would be the damage? Can someone explain that?
Congressman, our concern with the need for a federal legislative effort is that, as you know, a lot of these mortgages and mortgage contracts are governed differently in different states. So the advantage of a federal effort is that all consumers would be assured of a predictable, fair, and equitable solution, regardless of in what state they live. So that's our efforts have been designed to try to minimize disruption, and that's why we think there's great value in the federal legislative effort.
Well, I think there is too, obviously, but what happens if we don't have, for some reason, things happen around here? I don't know if you guys know why we're walking across the street so crazily today is because someone decided that we should vote on everything. This is not our normal procedure. Normally, we would sit here and talk to each other and we wouldn't be disrupted. I'm sitting here looking at the clock knowing I've got to run off. This is not normal. And sometimes things happen here that are abnormal. This is abnormal what's happening today, and I apologize that for your time. It's inappropriate. I apologize. But what would happen if somehow this thing were to fall apart?
Well, our concern is that there are some who may not move, or who may, be worried about expressing their discretionary ability because they don't know how it would be interpreted in various states. So the advantage of the federal legislation is that not only do consumers understand a fair and equitable solution will come across the board, but also those with the administrative abilities to move these contracts will be able to move them with some degree of
Dr. Coates, I understand the benefits of it. I'm asking the opposite. What are the risks? I mean, could anyone else answer that? What are the risks? What if this thing falls apart? What if we do have suspension bills and some crazy person decides that we have to vote on each and every one of them as opposed to just take them on block like we normally do? What happens if someone gets a wild hair here and we're not able to fix this? What happens? Can someone talk about that? What's the downside? Anyone going to take a shot? If not, I'll pick on somebody here. Brian Smith, go ahead. Brian Smith, I'll pick on you.
Sure, I'm happy to take that. As you say, it's really important that consumers don't have, their normal lives, their normal economic activity disrupted by something that, is far away and not something that they're normally paying attention to. So we've wanted to pay very close attention to that issue. If this Libor transition does not go well, people may not know what their mortgage payment is if it's linked to Libor. They may have their credit card payment disrupted. Financial markets may be disrupted. Lending to businesses may be disrupted. Litigation, will take over, and I think it'll be disruptive to markets and disruptive to consumers.
Thank you for your work. I really do appreciate what you guys are doing. Really do. Thank you. Y2K.
I believe that every member in attendance has asked their questions. Am I correct on that?
Mr. Chairman, Bill Huizenga here. I talked to a number of our members on the floor that I know were in the queue. I know some of them were trying to vote at the end of the last bill and the beginning of this one. So I'm not sure who our last Republican was. I had just walked in shortly. Do you mind informing me who that was?
Who was the last Republican to speak?
General.
Mr. who? Stivers. Mr. Stivers has asked questions.
Okay, I do know that Mr. Stile, Mr. Gonzalez, Mr. Hill, to name three of them, and I think Mr. Davidson were all in our queue. So I don't know whether they have returned or not.
And I see one. We do have a member to recognize. Mr. Hill is recognized for 5 minutes.
Hey, thanks, Chairman. Appreciate this good hearing on a super important topic. Thanks for your high quality opening of the hearing. And thanks for helping us navigate these votes this afternoon. Mr. Vanderweed, I want to start out just with sort of the big picture. The staff information I've seen says about $16 trillion of notional value that will be outstanding in legacy contracts after June 2023. Is that the right number for us to be thinking about of the legacy transactions?
I'd say that our expectation for total legacy contracts by mid 2023 is more in the range of 70 trillion. But only about 10 trillion of those will be what we would consider tough legacy contracts that have inappropriate fallback provisions that are very difficult for the contracting parties to renegotiate. So 10 trillion, I think, is the number that we're focused on.
Good. That's very helpful. Thanks for that clarification, because that was one of the items that I wanted to clear up. Mr. Coates, I've long advocated for this change. The whole 6 years I've served in Congress, we've been talking about it, and we're superb here in DC about talking about problems. And you're aware of that. In fact, last January, when FHFA testified, I asked then, what's the status of Fannie Mae and Freddie Mac being ready to go in their conversion? Can you give us an update, please?
Sure, and thank you for the attention to FHFA's work. Appreciate that. Our regulated entities have really done a lot of work to be ready for this transition. They started by writing new contract language within the confines of the ARC to ensure that those LIBOR contracts that were written had clearer fallback language. We then got consumer groups and all interested parties together with the ARC to set up new LIBOR arms, and they started building those. And then we have stopped, after we got those built, we have prohibited the enterprises from issuing LIBOR-based products anymore or purchasing LIBOR-based products. So they are largely transitioned away from SOFR or away from LIBOR and to SOFR in all of their mortgage-based products. So we feel pretty comfortable. The one remaining area is some derivative activities, and we expect the LIBOR-related derivative activities to drop off as SOFR derivative liquidity increases.
Good, thanks for that answer. So, Mr. Walsh, I was curious, in the majority staff's memo to the committee, they talked about some ambiguity for small and medium-sized banks and their discomfort with SOFR. You know, having been a former CEO of a medium-sized community bank, I really couldn't tell from their memo what's driving that. We didn't use LIBOR in our portfolio lending. We used Wall Street Journal Prime plus or minus, competing with obviously LIBOR quotes. Tell me what's going on with the community banks where they have discomfort with this.
Thank you for that question. It's a very important one. As my colleague Brian Smith mentioned earlier, that this SOFR is an overnight risk-free rate, and it has great benefit in that it is transparent. The two issues that community banks, as well as some corporate type borrowers, have expressed with respect to SOFR are that it doesn't include a credit component. It is an overnight risk-free rate. And there's much work being done at present to address that, to try to create a credit spread that would be appropriate to apply to SOFR to make it more credit sensitive. It's also, as I think Mr. Vanderweedy was describing, an average rate. LIBOR is a rate that is set in advance and paid in arrears. And there has been some concern expressed by various parties that they will find it difficult to manage their cash flow positions if they do not know at the start of a reset period what their final amount of interest rate due might be. And there is work being done. There is work being done to address that and trying to find a so-called forward-looking term rate for SOFR.
Okay, that's helpful. I hope you and your bank supervisors will collectively help push that education and collaborate on a solution there. Mr. Vanderweed, another question I was curious about, we talked about state legislation. The state of New York is curing part of this. How do you reference is the General Assembly of New York passed any legislation on this, and what percentage of the market might that assist?
Well, we think the New York legislation would probably cover a majority of the financial contracts out there that are under LIBOR. But for a variety of reasons, we do think federal legislation is really needed to provide that kind of a nationwide uniform solution and cover some of the federal Trust Indenture Act and tax issues.
Good. Thank you, Mr. Chair. Appreciate the time, and I yield back.
Thank you. Without objection, I'll enter into the record a letter from SFMA, the Structured Finance Association, the American Bankers Association, and the American Council of Life Insurers and others in support of federal legislation in this area, and a letter from the Structured Finance Association making basically the same point, and a statement from the Structured Finance Association. And with that, I'll recognize Mr. Davidson.
Thank you. I was expecting the rotation to go to Democrat, but it's nice to be in the queue. Thank you, Mr. Sherman. Thank you, Mr. Hill, and thanks to our witnesses. This is an important topic for our financial markets, and it's always good when Congress spends time on things that are actually substantive. So, look, a lot's already been said. I like that it's already been highlighted that this is an average. So it's designed to smooth out some of the day-to-day volatility. SOFR is an average, and it's designed to mitigate some of the volatility because of that. But I'm particularly interested in kind of going back to September of 2019 and the repo market. We saw that spike, and should we be worried about this happening again, Mr. Vanderweed? If so, what would be the implications that we would have under a new SOFR-based system?
Yeah, we have seen some dysfunction in the Treasury markets over the last couple of years. We saw it in September 2019. We saw it again in March of 2020. And we and our colleagues at Treasury and some of the other agencies are taking a hard look at what we can do to improve the resiliency of Treasury markets. I will say the SOFR spike, the Treasury repo spike in September 2019 was very short-lived, in part because of some of the actions that the Federal Reserve took in response to it. But because of the way SOFR is integrated into financial contracts through a longer-term average, spikes in SOFR that only last for a day or two, like occurred in September of 2019, are not going to have a bad volatility effect on the usage of that rate in the contract. So I think through the averaging mechanism, we've got a good mechanism to deal with some of the short volatility spikes that might occur in Treasury repo rates.
Okay, so do you anticipate enough stability in repo that the Fed will not actively intervene in repo, or how do you see that playing out? And what role does SOFR play in that?
And we think the averaging mechanism is going to be enough to deal with the volatility, the natural volatility in Treasury repo rates. But I should also mention that SOFR is not a mandated rate. We are not mandating that banks or financial firms use SOFR in their contracts. So if they're concerned about the volatility of SOFR, the potential procyclicality of SOFR for certain transaction types, they're certainly able to migrate to a different alternative rate.
In a crisis, of course, everyone hopes to first and foremost create some stability. But there was concern when kind of this high amount of interest was being paid out in the repo market, and it was being paid above what some of the offers were from other banks. So there were some banks who were maybe as high as 10%. Now that didn't last in an enduring way, as you've already highlighted. But I've heard from banks who say that they were offering to finance at substantially lower, and the market could have cleared, provided stability at a lower rate. Did you deal with any of those claims?
I think fundamentally, the disruptions in the Treasury repo market back in September were quite short term, and so they're not going to impact the nature of the SOFR rate that's going to be used in financial contracts. So those kinds of very temporary disruptions are not, I think, a black mark against the potential usage of SOFR.
Okay, Mr. Coates, what has FHFA done to ensure that its regulated entities are prepared to transition away from LIBOR? And what kind of exposure is there left for LIBOR?
Thank you for the question and the interest in FHFA's regulated entities. As I outlined earlier, the entities, Fannie and Freddie and the Federal Home Loan Banks, have been moving prudently away from LIBOR and to SOFR since we started this effort in 2018. They have worked, in Fannie and Freddie's case, they worked with the Consumer Products Working Group to develop new fallback language to ensure that those last few LIBOR contracts had clear roadmap for how they would transition. Then they worked with all the industry groups and consumer groups to develop an acceptable adjustable rate mortgage based on SOFR. And then they went and built that system. They have offered now SOFR-based adjustable rate mortgages and other mortgage products, and they are out of LIBOR mortgage-based products.
So,
yes, sir.
Won't there be about 2/3 still outstanding after 2023?
Well, as you may know, the exposure information is not public, but I'd be glad to follow up with you and discuss exposure information if you're interested.
All right. Thank you so much. My time's expired and I yield.
Thank you. Without objection, we'll add to the record a letter from the United States Chamber of Commerce and related organizations supporting federal legislation along the lines of the discussion draft that's been circulated. A letter from the Alternative Reference Rate Committee supporting the specific draft that has been circulated, and a letter from Americans from Financial Reform, the National Consumer Law Center, and the Student Borrower Protection Center supporting the New York legislation, which is substantively identical to the discussion draft that has been circulated. With that, I recognize for 5 minutes, Mr. Emmer. Mr. Emmer, are you there?
I am.
Good.
If I could yield my time to Mr. Gonzalez, please.
So, Mr. Gonzalez, you're recognized.
Sure. That caught me off guard there, Tom. But in any event, well, thank you for yielding. Thank you, Chairman Sherman and Ranking Member Huizenga, for holding this hearing today. Certainly an important topic, and I want to also commend the ARC for the work that they've done over the years. I feel like if the ARC didn't exist, we'd be probably talking about how to create it and make sure that it did today. So I certainly appreciate all the work and all the thought that has gone into the various proposals. My first question, I want to start with Mr. Smith. I was pleased to see that the state of New York just enacted legislation that does provide for a legal safe harbor to address financial contracts that have inadequate fallback language, which we know sort of comprises that tail risk. However, it doesn't fully address the federal issues. So from this past year's experience, we know that securitization trustees, for example, were taking steps toward initiation of litigation, which is more than a year prior to the original Libor end date of December 2021. So with that as the backdrop, how concerned are you that we would see additional litigation soon? And maybe paint a timeline for us. The longer it takes us to enact something at the federal level, when do you see the litigation coming in and what kind of volume?
Thank you for the question. And, as you highlighted, New York has taken an important step to managing risk for contracts based in New York law, but there remains a necessity for federal legislation, both to make sure we have a comprehensive and uniform approach that covers, all of the United States, as well as because of the unique federal issues. You identified the Trust Indenture Act issue. That's one of several issues. We also want to make sure at the Treasury Department that we can manage the tax consequences of Libor transition and make sure that doesn't become an impediment. There are certain legacy federal student loans based on the legacy program that have a reference to Libor and statute. Those are just some of the federal, issues that we want to make sure to manage. And as you highlight, litigation is certainly a risk if they're not managed appropriately.
Thank you. Do you suspect that Treasury will provide legislative guidance or suggestions with respect to handling the tax consequences and the issue in the student loan market?
Yes, Treasury has provided technical assistance on the draft legislation related to managing the tax consequences, both ensuring with an aim of ensuring that tax realization events are not triggered by the move from Libor to SOFR, including by this legislation, as well as making sure Treasury has appropriate authority to do rulemaking to cover the broader range of technical issues that might come up.
Great. And then for Mr. Dan Coates, without an appropriate authorized alternative solution, many of the parties responsible for directing Libor-based calculations have already notified the contractual parties that they will seek court direction. Can you explain the implication of massive litigation on financial markets, and then who ultimately would bear the cost of this litigation?
Well, I appreciate your question. There are a lot of entities that will bear the costs if folks don't move. As you know, Fannie Mae securities are governed by DC law, Freddie Mac's by New York state law, and the federal home loan banks are all around the country. So the challenge if folks don't move and is that all lawsuits happen all over the place. We already saw this before the New York state law was started. Trustees were starting to go to the courts to seek resolution. So that's the real challenge, is that this transition would be stalled in 51 jurisdictions, and that could end up getting different outcomes in the different jurisdictions, and that could affect consumers differently. So we're very concerned about that.
Thank you. And then with my last few seconds, according to market participants, who I hope we hear from publicly at some point, implementing the transition will require significant operational and systems changes. So based on the current timeline, are you concerned about interruptions to the marketplace? And that one's for either Mr. Coates, Dan Coates, or Mr. Smith.
I'll just take a shot at it. We've seen good progress. The ARC has had an infrastructure working group to bring vendors in to get them ready, and we have every expectation that things will make more progress.
Thank you, and I will yield back to Mr. Emmer. Or just yield back altogether. I don't know if he's on.
I don't see him. I do want to comment that the discussion draft that I've circulated does contain as section 6 a provision that shifting from one index to the other index does not constitute a sale, exchange, or disposition of property for tax purposes. The other technical assistance that Treasury has sent in was just received yesterday, and I know that'll be very interesting to myself, Mr. Huizenga, and others working to perfect this draft. With that, I'll recognize Mr. Stile for 5 minutes.
Thank you very much, Chairman. It's been a good hearing today discussing LIBOR. I want to shift gears slightly just for 1 minute, if I could, while we have you, Mr. Coates. I'd like to ask you about just some recent statements from your office regarding SPACs. Last week, you put out a statement kind of opining whether SPAC mergers were the IPOs, and a popular commentator called the remarks a weird speech, his words, that was really, quote, advice for plaintiffs' lawyers, end quotes, also his words, rather than anything related to kind of SEC enforcement priorities. And then this week, alongside the SEC's acting chief accountant, you issued another statement that I think had some market implications regarding how warrants are issued and SPAC offerings and how they should be treated for accounting purpose. One of the major law firms actually noted that it is essentially frozen the SPAC marketplace as a result of some of those comments. And the firm pointed out in their public comment that I read that you were not aware that they were not aware of a statement put out without notice or comment that had such a chilling effect on capital market activities. And I noticed, I read your statement, I noticed there was a pretty solid, well-written disclaimer in the footnote of your statement. But admittedly, despite that, I think many people out there are worrying that these comments may have greater teeth. Did you determine these significant market moving statements are appropriate?
So thank you for those questions about SPACs, and I'm happy to give you a quick answer now. I don't want to distract from the LIBOR focus of the hearing, and I'm happy to follow up, in much greater length if you'd like after this with my staff, your staff. Very briefly, yes, we believe that the statements were appropriate for protection of investors and for protecting issuers and capital formation. I'll note that the accounting statement that came out this week is not reflecting anything new. The guidance comes from FASB. That guidance has been there for years. And the reason that we put it out was because a particular registrant came to us with the questions and asked for our advice, and we gave it. Once we gave it, we recognized it might have implications for other issuers and did not feel comfortable not telling the market about the conclusion that we'd reached about that question. But again, as I say, I'd be happy to follow up later if you'd like with more information.
No, that's fine. That's actually very helpful background as to kind of the orientation of the formation of those comments. Should we expect a more formal rulemaking on this issue in the near future?
I guess I would have to say I look forward to working with our new chair, who will come on board very shortly, and to talk about that issue with him and the rest of the staff at the SEC.
Very, very, very good. Appreciate you letting me shift gears there for a second. Let's pivot back to LIBOR, which I've actually been pretty interested in since I first arrived on this committee. I spoke about this topic in 2019, and while it seldom makes some of the front page of the newspapers, I think the Libor transition is actually one of the more important stories affecting our economy. And so if I can ask a question for you, Mr. Vanderweed, In a speech delivered to the Alternative Reference Rates Committee last month, Vice Chairman Quarles sought to address rumors that the transition from LIBOR will be delayed further. Do you think the message has been fully received, that LIBOR is really ending? That's one of my concerns. And then in particular, how do New York's recent moves impact the pace of this transition?
Yeah, I think the statements that we heard last month from the UK's Financial Conduct Authority and the administrator of LIBOR, IBA, were pretty definitive that the major US dollar LIBOR tenors are ending in June 2023. I think that message is getting across. We're certainly getting that message over and across during our supervisory process. We've issued, along with our sister banking agencies, the OCC and the FDIC, several pieces of supervisory guidance over the last few months, and that is reinforcing the significance of the imminent demise of LIBOR and the cessation of writing new contracts under LIBOR. So I consider the end of LIBOR to be set at this point in the middle of 2023.
I appreciate that. Observant of the time remaining, appreciate everyone's time today discussing this important topic. And with that, I will yield back.
Thank you. I assure you, Mr. Stile, that we'll focus on SPACs at the subcommittee level expeditiously. And without objection, I'll put on the record a letter from the National Association of Federally Insured Credit Unions supporting the idea of Congress taking legislation promptly on LIBOR contracts consistent with the discussion draft that's been circulated. With that, I believe the next person in line is Mr. Hollingsworth, who's recognized for 5 minutes.
Well, I appreciate the chairman recognizing me and certainly appreciate all the witnesses that we have here today. As my good friend, Mr. Stiles said, this is an important issue. The numbers that we're dealing with, and certainly the chairman introduced this concept, are enormous, and making sure that we have a elegant solution to this transition is really important to both the real economy and the financial economy. And nothing I'm going to ask about should minimize my sympathy for the problem that we have before us in transitioning a whole host of contracts that don't have a appropriate fallback or any fallback at all. All that being said, and with the additional perhaps preamble of me not being a lawyer, but always concerned about the rights of parties to contracts, I wanted to ask Mr. Vanderwee, I hope I said that correctly, do you have any trepidation or concern about the notion that the Fed is going to pick a rate, and that rate is going to be conclusive and binding upon parties that have agreed to a contract, and they, at least as I read the legislation, will not be afforded any sort of litigation avenue, cause of action, or other redress should they disagree with that? Is that disconcerting to you? I understand the problem that we have ahead of us, but are we going too far in saying presumptively, if you don't contest it, this is the rate, but instead saying this is the rate, period, your only option is to contest this law altogether, not contest with the counterparty whether that's the right rate?
I do want to agree with the impulse here that it should be a rare situation when Congress or a legislator is overriding private contracts, and you only want to do that in a very narrow way for a very important government purpose. I think we have a very important government purpose here to prevent financial stability and negative effects and the litigation that may come by mid-June. And we want to do this in the most narrowly tailored way possible. So I do think the federal legislation needs to be strictly limited to legacy contracts. It should not be relevant to looking forward new contracts. It should only apply to legacy contracts that have a no fallback rate or an inappropriate fallback rate. And people should have the ability to opt out of the rate that is set by the legislation. So if the two contracting parties take a look at where the government recommended rate is and they don't like it and they want to go a different route, they should be able to amend their contract and opt out. So I think that's the way to kind of maximize the benefits here.
So number one, I really appreciate that very thorough answer. I certainly concur that this is a big problem ahead of us. I certainly concur with I'll characterize it as a hesitation or desire to narrowly do this. And then third, this is actually the first time I've heard someone say there should be an opt-out or a means of redress should they disagree with that. And that's something
that's a bar that I also agree with. I have a little bit of concern. I like the idea of minimizing the logistical hurdles by saying this is the rate unless you can test it otherwise, and maybe even setting timeframes around that, then this is going to be your rate, reference rate going forward. But I want people to have the ability to contest that because they ultimately are the parties to that contract. And if they believe that's inappropriate, they should have their day in court to go argue before a judge and have that judge determine whether it is appropriate or inappropriate what has been done. Is that kind of what you are saying as well? Not to characterize what you're trying to say.
Well, I think the fundamental issue here is, do you want to have a legislature step in and provide clarity to the financial markets about what some of these replacement rates are going to be for that tranche of contracts that are tough legacy? Or
yeah, but as you said, we don't want that clarity to come at too high a cost, right? And if we, by principle of government, believe you should have access to the judicial branch to argue in front of a judge and have a judge decide what is appropriate or inappropriate, I believe that if you abandon your principles at a time when a big problem is afoot, then you probably didn't have those principles to start with.
Yeah, I think the balance you have to strike is between the clarity that we really need when LIBOR goes away in 2023 and the judicial right of review. And I think, the more judicial right of review you're going to have, the more litigation we're going to have, the more uncertainty we're going to have in the financial markets. So we got to strike the right balance between those two instances.
I think you're exactly right. Balance is the operative term. And certainly I would love to work with Chairman Sherman in further fine-tuning this. I think he's on the right track, but I think that's striking that balance to make sure there is a means for a party that agreed to a contract to debate and discuss that in front of a judge is really important to me. Thank you. I'll yield back my time.
Thank you. One clarification for the record. I think the record was already clear. The Americans for Financial Reform, the National Consumer Law Center, and the Student Borrower Protection Center have not endorsed federal legislation. They have not endorsed the drafts that I've circulated. They have endorsed the New York bill, which is substantively identical to the federal legislation that we're discussing here today. And that is as far as they've gone. I think I've correctly characterized them twice in this hearing already, but that will be a clarification. At this point, I believe we've heard from all members who have asked their questions. What I'm going to suggest is that Mr. Huizenga grace us with a 1-minute closing statement. I will then deliver a 1-minute closing statement. And at that point, our members and witnesses can zoom off to their next meeting. Mr. Huizenga.
Thank you, Mr. Chairman, and we'll zoom off to our votes as well. And I do appreciate you having this. I know this was something that has been important. What I'm hoping for is in the next hearing that we're going to be able to hear from market participants, those that are going to be affected by this material change in those contracts. As I had started to explore a little earlier, it sounds like we need to have some legal experts in here as well to just comment on the constitutionality of this. And I know you believe that you have addressed this, or at least certainly attempted to address this. But looking at what the legality of this effort is an important part of this process in my mind. And as has been noted, June of 2023 is that sort of drop dead dime. In classic Washington experience, that would mean May of 2023 is when we would get to it. But we are well ahead of that game, and I commend you for that, and glad to be a part of it. Look forward to working with you on this.
I look forward to working with you. The importance of this issue is at least $2 trillion in instruments that will still be outstanding after the middle of next year that do not have a fallback position. But if I heard Mr. Vanderweed's testimony correctly, his number is closer to $10 trillion. I realize we're dealing with $200 trillion and evaluating what is so many different instruments and applying that would be is difficult. So we may be dealing with a problem that involves $10 trillion in instruments. As to the sanctity of contracts, I think that that we can deal with legislative counsel and maybe the experts at CRS. I don't anticipate having another hearing where we bring in legal experts, but if we don't get a clear answer from them, then we do have to make sure that our bill will be constitutional. I'll point out that the principle of the sanctity of contracts is a principle important to all of us in every circumstance, but as a constitutional matter is applicable to state legislation. I'll also point out that New York State has passed legislation that would govern many of these instruments unless we pass our bill, adding to the confusion, and the constitutionality of their bill is much less certain. And finally, let's point out, as far as sanctity of contracts, the 95% plus that drafted contracts that are clear as to how they would provide, apply in a LIBOR-less world, though the sanctity of those contracts is being respected. Where the parties didn't agree, it's much more efficient to have a bill than to have hundreds and hundreds of lawsuits. Although, as an old-time lawyer, the idea of my colleagues billing thousands and thousands and thousands of hours is something that they would want me to support. With that, we stand adjourned.